Okay, so we're doing part 2 of chapter 9. Chapter 9 is kind of complicated, so I tried to break it down for you into, what we talked about in the first part of class on Tuesday and what we'll be talking about today. So today we're going to be talking about some issues that can happen when you're out in the real world. So one of the things is, if possible, the cash exchange price of the asset acquired should be used as the basis for recording the asset and measuring interest. Sorry, I'm playing around with the format here. If the cash exchange price is not available, then the asset should be recorded at the fair value of what was given up. Assets purchased on deferred payment contracts should be accounted for at the present value of the consideration exchanged. If no interest rate is stated or stated as 0 interest, then the company must calculate an imputed rate. Calculate the imputed rate. Consider the borrower's credit rating, the amount and maturity date of the note, and prevailing or market interest rates. Similar risk. And assets. So basically that means, kind of ties into what we did with the capitalization, right? With the capitalization, of interest, we looked at those interest rates and we said, well, okay, what's our borrowing rate? And so you could do something similar like that for this company as well, if you had a zero interest bearing note. I'll leave that up there for a minute, give you guys time to get it all down. All right, now I'm right in front of where you probably want to finish reading, but I can't get this thing to move with all the other things I have in the header. Oh, technology is thwarting me today. I'm just going to do a quick search for present value tables. Okay, so I apologize for digressing for a second, but I wanted to talk when we talked a little bit about present value. Now, the expectation when you come into this course is that you kind of already had these in intermediate one, but if you need a refresher, I'm happy to walk through them and help you with questions. But when we're looking at one, we have present value of $1. So that's a lump sum amount that you're going to have to pay in the future. And so if we want to figure out what that lump sum amount is, we have to figure out the number of periods and then the interest rate. Now, keep in mind, for the most part, the interest periods we'll assume will be yearly and we won't do compounding. But no, in the real world, oftentimes they're doing compounding on kind of a monthly basis. So it may differ slightly from what we're doing in here. But we're going to use these tables or tables that are similar in your textbook for present valuing our assets. And so we can take a look at example one. Assuming that Caribou Coffee purchases a new espresso machine for today in exchange for a $10,000 zero interest note bearing note payable 4 years from now. So how would you record the asset assuming the market rate of interest is 9 periods? So you'd look for 4 periods and 9% interest. And so we come out to 9%, 4 periods, and we have 0.708. Keep in mind with present value tables, depending on how their rounding is, they're going to be slightly different from the other tables. So if your textbook wants you to use a specific table, make sure you use that specific table. All right. So that is equal to 0.708. And then we multiply 0.708 by the 10,000 to get the present value. And so 7080, I think is what that is. Okay. And so our entry would be debit, espresso machine, asset, right? For 7,080. Debit discount on note payable. And this will be a plug for the difference. And a credit for note payable for 10,000. We take our 7080, subtract 10,000. I think it's gonna be 2920, but there we go. 2,900. Now remember with the present value tables, this is one lump sum in the future. When you have an annuity factor, that means you're getting multiple payments. And so that one is different. And what you'll see is you'll see a normal or in arrears, and this assumes that you're paying at the end of the first period. If you're paying at beginning of first period, then you need to make some adjustments, and that's an annuity due, it's called. Garcia purchased a truck by issuing an 80,000 four-year note, zero interest bearing to Equinox. The market rate of interest for obligations of this nature is 10%. Prepare the journal entry to record the purchase of this truck. So again, we know it's going to be truck, long-term asset, and then we're going to have discount on note payable, and then note payable. We know the note payable is 80,000. So we need to go out to the thing and find our 4-year 10%. And so that's 0.683. And so we multiply the 80,000 by the present value factor, 0.683. And we end up with 54,640. And that's approximate, by the way. I think if you do it exactly, you get a slightly different number, but we're just rounding here. And 25,360. Any questions there? Okay, let's look at example 3. So you say, well, where would this kind of stuff come from? Generally speaking, when you make something, you're going to put a price on it. But in this case, we're going to have to go by what we received in the market value for it because they said they couldn't put a price on it. So here we are for our debit, and we got robot paint sprayer. And then I assume we're gonna have a discount on notes payable. And then we'll have notes payable. And that's the easy one, 100,000. And so now we have to find, remember we have an annuity table and it's 10% and it's 5 installments made at the end of the period. So we come down here, 5 years, we go over to 10%, and I get 3.709, or excuse me, 3.7908. $20,000, which is the annuity, multiplied by 3.79, was it 08? I think. And so when we multiply that out, we get 75,816. And then the discount on the notes payable is just the difference, and that's a plug of 24,184. Now you say, well, why would we do this? Because we're using the discount, we're going to be recording interest now expense over those 4 or 5 periods. And we're also building up, or we're eliminating our discount on notes payable. And I want to go down to the table at the bottom. I really should have put this at the top, but let's talk about how their payments are going to work. Okay, we know their interest is 10%. Then we know that the present value equals 75,816. That comes from our number here above. So in 2025, we're going to make a $20,000 payment on 12/31. The interest is going to be our balance, 75,816 times 10%, market rate, right? And that equals 7,582. And so the principal, what gets applied to the principal is 20,000 minus the 7,582 that was interest. And so that equals 12,418. And so now we take the 75,816 and we subtract the 12,418 and we get 63,398. Have you guys done one of these tables before? This is basically what you're doing when you're calculating the effective interest rate method, right? We could have easily taken the difference and just divided it up over 5 years and said, we're going to do it this much over 5 years. But the effective interest method allocates interest when the principal is high to interest expense, and when the principal is low, the payment goes to principal. So we see what's breaking down here. So then we're going to go ahead and do the next year, 20,000. Here we're taking the 63,398 balance and multiplying it by 10%. And that's going to equal 6,340 rounded. And so now we take the 20,000, subtract the 6,340, and we end up with 13,660, which reduces our balance on our loan. And that's 49,738. Now I'd like you to try 2027. Okay, so let's jump into this one. If we made a $20,000 note payment at the end of 2027, we'd have interest expense 49,738 times 10%. And what would they be? 4,974? About right? Excellent. So now we take the 20,000 because we want to find out how much is going to be applied to the principal, and we subtract the 4,974 that's going to interest. So is that 15,026? And so now we have 49,738 minus 15,026. 34,712. All right. And so we would expect over the next 2 years, 2028 and 2029, when the last payment is that this will go down to zero. And that's because we're making payments on it. So what does that entry look like? For 2025 and 2026, we've got all this information here. And remember that we have to record interest expense. For the amount shown here, 7,582. We also made a payment on the note, right? So that reduces our notes payable. We're going to credit cash because that's what we're paying, 20,000. And then we're going to reduce our discount on note payable by the 7,582. Okay, you guys try December 31, 2026, sorry. Okay, so our entry is going to look exactly the same, but our numbers are going to change and we're going to pull them from the 2026. So we have interest expense, 6,340. The notes payable, 20,000. Cash paid out is 20,000. And the discount on notes payable, 6,340. Any questions there? Purchasing a goop of plant assets on a site that I would ever want to visit. So when we did this before with inventory, this is the same type of thing that happens. Oftentimes they'll purchase assets from a company that's going out of business and they'll say, listen, I'll give you 20,000. I want all the equipment in this room. And as a result, that's a lump sum and you have to go through and allocate based on the fair value, just like we did with inventory before. And so you allocate the purchase price, the assets to the individual items. On the relative fair value of the assets. Oh, too many assets there. Acquired. To determine the fair value, a company should use valuation techniques that are appropriate for the circumstances. Based on industry practice or quoted market prices. Would be two examples. I'll leave that there so you can still see it, write what you needed. Okay, so now we're looking at example number 4. Company purchased land, building, and equipment from Laguna Corporation for a cash payment of $315,000. The estimated fair value of the assets are land, $60,000, building, $220,000, and equipment, $80,000. So when I do the maths, as they say over in Europe, I get 360,000. So now we want to determine what percentage of the total is each asset. So I'm not going to put the zeros in here, but just so you know, 220,000, 360,000, and 80,000 divided by 360,000. And we're going to multiply it by the cost, 315,000. Let's figure out what some of these are. 60 divided by 360. Oh, good. Give us a repeating one. And then this one would be 61. .2222. All right. And so when we multiply those out, we get 52,500, 192,500, and 70,000. And when we add that up, we should get 315,000. Any questions? Hopefully that should look really similar to you based on what we did with the bucket purchase for inventory. Okay. So now issuance of stock. When assets are acquired in exchange for a company's stock, the best measure of the cost of the assets is the market value of the stock issued. Stock almost always has a market price. And so in general, if you're not sure what the assets are, you can use the fair market value of the stock. Okay, so let's take a look. Fielder Company obtained land by issuing 2,000 shares of its $10 par value common stock. Land was recently appraised at $85,000. The common stock is actively traded at $40 per share. Prepare the journal entry to record the acquisition of land. So this would be land. And what they did was they issued 2,000 shares at $40 market value. And so that's $80,000. Then you have common stock at par. So 2,000 times 10. That's 20,000. And then you have paid in capital common stock for the difference of 60,000. Okay, I put this in there because, I know you're like, why do you want me to not type this and have me type everything else, right? Sometimes I choose to not have you type stuff. So this is an exchange of non-monetary assets. And you'd say, well, where does this come up? Maybe somebody needs a truck and they own a skid steer, little tiny bucket loader thingy, and they want to trade them. That would be an example of a non-monetary exchange. In that case, the assets are similar, but somebody could be getting out of the business and getting into a different business. So it's not necessarily that the businesses are similar. And so companies account for the exchange of non-monetary assets on the basis of fair value of the asset given up or the fair value of the asset received. And this is where it's important, whichever is clearly more evident. Companies should generally recognize immediately any gains or losses on the exchange for transactions that have commercial substance. And the exchange has commercial substance if the future cash flows change as a result of the transactions. Now, I used to think that it was because cash was given up as part of it, and that can be part of it, but think about how the future cash flows are going to change as well. If that truck had a longer life than the asset that you're going to have, if it had a different revenue capability, that would be something that has your future cash flows changed. And then losses are always recognized. Pretty straightforward, right? We're conservative with accounting. We're always going to recognize it. We recognize immediately on the gain if it has commercial substance. If no commercial substance, unless cash or other monetary consideration is received, we would defer the gain until the actual sale of the asset. If there is some cash received, you can calculate it as a portion and report a portion of the gain related to the cash. Okay, so Navajo Corporation traded a used truck, cost $20,000, accumulated depreciation $18,000. So what's our book basis? $2,000, right? You guys are familiar with that term, the basis, the book basis, cost minus depreciation for long-term assets gives you the book value. For a small computer with a fair value of $3,300, Navajo also paid $500 in the transaction. Prepare the journal entry to record the exchange. And note here, the exchange has commercial substance, so we're going to have to recognize gains or losses. So we're getting in this computer equipment, and we know that's $3,300 value. What else do we know? We know that we have to remove the accumulated depreciation for the truck off of our books because we're selling it, 18,000. I'm gonna leave a space open because I don't know whether or not we're gonna have a gain or loss here, so I'm leaving the entry open. And we're gonna be getting rid of a truck, so we're taking that asset off our books for 20,000, the historical cost. We're also paying cash of 500. And we have to figure out, okay, did we gain or did we lose on it? So what did we give up? Oh, 20,500? No, 2,500, right? Right. Okay, when we received $3,300 computer or fair value. And so we take the 3,300 and we subtract the 2,500, and that equals 800. In this case, this is a gain. $2,700 in value, or an asset with book value. Oh, I'm sorry, I did the math there wrong. 2,800 in value, right? With a book value of 2,800. I'm just a little off today. So a debit would be a loss. So we don't have a debit here. So we have a credit for gain on disposal. And that is 800. And we always check, does the entry balance? 21,300, 21,300. So now we're going down to example 7. Use the information from example 6. Prepare the journal entry to record the exchange, assuming the exchange lacks commercial substance. So now here we can't recognize the gain, right? So what we have to do is we have to back out the value of the gain. So computer equipment would be 3,300 minus the 800. And so we would record it at 2,500. We'd still have accumulated depreciation. We would have to get rid of the truck, and we would reduce our cash. Any questions on those two examples? Okay, let's take a look at number 8. Okay, Meta Company traded a used welding machine, cost of 9,000, accumulated depreciation of 3,000, so $6,000 book value, for office equipment with an estimated fair value of $5,000. Meta also paid $3,000 in cash in the transaction. Prepare the journal entry to record the exchange. Oof. Right? So we have office equipment for $5,000. We have to get rid of the accumulated depreciation on the welding machine. And so that was 3,000. I'm going to leave that middle one open because I don't know if it's a gain or a loss yet. We're going to get rid of the welding machine at its face or historical cost, 9,000. And then we also paid cash on this one. Of 3,000. So essentially, welding machine book value equals 9,000 minus the 3,000. And so that's 6,000. So we received machine for 5,000, but paid out 3,000. And so net gave up $9,000 to get 5,000. And so that equals a $4,000 loss. And so this would be loss on disposal of welding machine. Any questions on that one? No? Okay. Number 9, Chen Company traded a used truck for a new truck. The used truck cost $30,000 and had accumulated depreciation of $27,000, so a $3,000 book value. The new truck is worth $37,000. Cheng also made a cash payment of $36,000. Prepare Cheng's entries to record the exchange. So, truck, new, and that's 37,000. We have accumulated depreciation for the old truck. And I'm going to go down 2 lines and old truck, eliminate that one. We know that old truck was 20,000. Oh no, I'm sorry, 30,000. And has accumulated depreciation of 27,000. And we know we also gave up cash of 36,000. So we can look at this and say, okay, I've got 66 here, 54,000 here? No, 64,000 here. And so we'd have loss on disposal of old truck for 2,000. So how is that calculated? 30,000 minus the 27,000 equals 3,000 And then the fair value of the new, 37,000 minus what cash was given up, 36,000 equals 2,000 loss. So basically you got $1,000, but your book value on it was $3,000, right? Elon calling. All right, ready for example 10? All right. Slayton Corporation traded a used truck for a new truck. The used truck cost $20,000 and has accumulated depreciation of $17,000. The new truck is worth $35,000. Slayton also made a cash payment of $33,000. Prepare Slayton's entry and record the exchange. The exchange has commercial substance, so we'll be recognizing a gain or a loss if appropriate. So we have truck new, 35,000. Accumulated depreciation for old truck, 17,000. We get rid of the old truck, 20,000. And we also provided cash of 33,000. And so now you calculate whether or not we have a gain or a loss. So the easiest way to do it is to say, listen, I know I got all this other stuff right, and I'm short 1,000 on the debit side. And so that's my loss on disposal of old truck. And again, you want to think about, okay, what do we get? In this case, we had 35,000 fair value of truck, but paid 33,000 cash. So received 2,000 for a vehicle with a book value of 3,000, which is 20,000 minus the 17,000. Fire away. Right, so you always recognize the loss. Just remember that third part, always recognize the loss. Not necessarily the gain if it doesn't have commercial substance, but losses are always recognized. You're welcome. So I know we talked a little bit about this on the practice questions on Tuesday. And we have to capitalize. We're looking now, sorry, I kind of ran this up against this, but properly account for costs related to PP&E after acquisition. So we capitalize costs incurred to achieve greater future benefits from the asset, generally classified as additions, improvements, rearrangements and reinstallation, and major repairs classified as one of the above. And when they mean one of the above, they mean one of these above. And so when do we have? We have some rules that we capitalize if all three are met. And one is that if it increases useful life, increases production quantity, or increases production quality. And I said, if all of these are met, but only one of those three has to be met, excuse me. And then note on here, expense costs that simply maintain a given level of service, ordinary repairs, also called maintenance. Here's some information about improvements and replacements. And in this case, the major problem in accounting for improvements and replacements concerns differentiating these expenditures from normal repairs. And so these may be accomplished in one of three ways that they do capitalization. Substituting the cost of the new asset for the cost of the replaced asset. Capitalizing the new cost without eliminating cost of the asset replaced. And C, debiting the cost to accumulated depreciation. For rearrangement and reinstallation, costs are generally carried forward as a separate asset and amortized against future income. I don't like amortized. Put depreciated. And when they say carried forward here, know that they mean that they capitalize those costs. Okay, we've got one example left and then we are done for today. You guys can take about 2 minutes, make your guesses, and we'll go from there. Okay, so let's walk through these. It says indicate which of the following costs should be expensed when incurred. And so it says 13,000 paid to rearrange and reinstall machinery. And so this one would be capitalized. Number two, 200,000 paid for an addition to the building, capitalized. 200 paid for a tune-up and oil change on the delivery truck. I heard somebody. Expensed, right? 7,000 paid to replace a wooden floor with a concrete floor, capitalized. And 2,000 paid for a major overhaul on truck which extends its useful life would be capitalized. And just a little note here. All the costs except number 3 would be material if accounted for incorrectly. So while we look at 13,000 and 7,000 and 2,000, we're assuming here this is a smaller company. Okay. Any questions? If not, y'all are free to go and have a great weekend. What's that? Absolutely. I appreciate you guys. Thank you, Sonia, for being on the stream, and I will see you on Tuesday.